Hi, class. Welcome to week one. I'm your professor, Georgia Clark. I hope everyone is doing okay. I hope that everyone read the announcement that I posted, kind of detailing what was due this week. If you haven't gotten a chance, just take a look at it. Sorry, I still have a little bit of a cold, but I am so excited. When I read through the getting to know each other, I saw that a couple of you chose chapter 2 or chapter 3 as a topic that you'd like to go through. I decided that I'm going to go over chapter 3 every week. I'm kind of going to go over a chapter to cover with you guys. So this week we're going to go over chapter 3, ethics, fraud, and internal controls. So what are the objectives for this chapter? We're going to understand the broad issues pertaining to business ethics. We're going to have a basic understanding of ethical issues related to the use of information technology. We all know how information technology is just taking over everything, and there could be a lot of ethical dilemmas with technology. We're going to be able to distinguish between management fraud versus employee fraud. I wonder, who do you guys think commit more fraud? Do you think it's management that commits more fraud, or do you think it's the employees? We're going to be familiar with common types of fraud schemes, and we're going to be familiar with key features of the COSO internal control framework. I think I kind of noted at the beginning of the week that when I was an auditor, back in the day, SOX had just came out, and that was one of the things that we were really into, was the COSO framework and doing this kind of internal controls audit, because proper internal controls, especially with your systems, is going to help have financial statements that don't have material misstatements in them. And finally, we're going to understand the objectives of and application of both physical and IT control activities. So, ethical issues in business. What are ethics, right? Everyone know, from we're taught from children, we're taught that we should have ethics. What are they? So this says ethics pertains to principles of conduct used in making choices and guiding behavior in situations involving the concept of right and wrong. Business ethics involves answering two questions. How do managers decide what is right in conducting business? Once recognized, how do managers achieve what is right? Businesses having conflicting responsibilities to employees, shareholders, customers, and public. Every decision has consequences. Seeking a balance between the consequences is a manager's ethical responsibility. The benefit from a decision must outweigh the risk, and no alternative should provide greater benefit or less risk. So what does that all mean? So a lot of time businesses, we're trying to please our key stakeholders, which we have the employees, the shareholders, the customers, and the public. Sometimes those are very conflicting things. Sometimes we're trying to just please shareholders. Shareholders like to see that things are profitable. At the end of the day, a lot of shareholders, their ultimate goal is profitability. So does that mean that we play our employees very little and, don't do good social responsibility in order to just make things as profitable as they can be for shareholders? So those are the kind of things that we have to think about. So these are the ethical issues in business. So, equity, wealth. So there's the executive salaries. I don't know if you guys have watched a lot of people complain and saying, wow, some of these executive salaries are very exorbitant. There's comparable worth. There's the product pricing. Is the product pricing too high? Is it too low? There's rights. There's like corporate due process, employee health screening, employee privacy, sexual harassment. I know everyone has been seeing all the different things with sexual harassment being rampant at different workplaces and Hollywood. So, those are the kind of things we want to think about. Diversity. Is there diversity in the company? Is there equal opportunity? What are the rights of whistleblowing? A lot of times people feel like, hey, if I'm the person that whistleblows, is my career over? Is there compensation for me, or am I going to get blacklisted? Then there's honesty, there's employee and management conflicts of interest. There's security of organization data and record. There's misleading advertising, questionable business practices in foreign countries, accurate reporting of shareholder interests. And then, of course, exercise of corporate power. There's, different political action committees, lobbyists, basically, workplace safety, product safety, environmental issues, divestment of interest, corporate political contributions, downsizing, and plant closures. So those are all the things that we're thinking about. Ethical issues in business, computer ethics. So analyze the social impact of computer technology and formulation and justification of policies for the ethical use of technology. Para-computer ethics involves taking an interest in computer ethics cases and acquiring some level of skill and knowledge in that field. Issues of concern, privacy and ownership in personal information industry. I know a lot of time, everything these days, it's like we give out so much information. Just think of I can't remember which one, if it's Equifax that had the huge data breach. So a lot of time every day you hear of huge data breach with our information just gone. Security involving accuracy and confidentiality. What can an individual or an organization own? Equity of access issues related to economic status, culture, safety. Environmental issues, artificial intelligence, unemployment and displacement, and computer misuse. So I don't know, there's so many things a lot of people are saying, with artificial intelligence, is it ethical that they now, with robotics and all this stuff, it's going to put a lot of people out of jobs. So there's just so many ethical issues that we have to deal with in business. So I think we've all probably in our previous accounting classes talked a little bit about SOX. We all know SOX came about because people at AICPA felt, like without proper internal controls, then chances are the financial statements that we get, the information that we receive from the company could very much have false information. So compliance with Section 406 of the Code of Ethics says that we have to have procedures for dealing with conflicts of interest. We have to have full and fair disclosures to ensure candid, open, truthful disclosures, requiring employees to follow applicable laws, rules, and regulations, a mechanism to permit prompt internal reporting of ethical violations. That's like a whistleblowing hotline, and taking appropriate actions when code violations occur. So fraud and accountants. Obviously, fraud is a big thing when you're an accountant, especially when you become either an external auditor or sometimes you can be an internal auditor at the company. So the passage of SOX has had tremendous impact on an external auditor's responsibility for fraud detection in a financial audit. The objective is to seamlessly blend fraud consideration into all phases of the audit process. So every time we're auditing, we're looking to see that fraud is not occurring. So what kind of frauds are there? There's false misrepresentation, false representation, false statement or disclosure. Material fact. Fact must be substantial in inducing someone to act. Intent to deceive must exist or knowledge state as false. Justifiable reliance. Misrepresentation must have been relied on. So it's one thing for the company to have said something false, but that false information that they said, did someone rely on it? If they're saying that if you didn't really rely on it, then it's not necessarily fraud. And then injury or loss must have been sustained by the victim. Fraud in business has a more specialized meaning. intentional deception, asset misappropriation, or financial data manipulation to the advantage of the perpetrator. I think we go to these things as CPAs, they're called CPE, so you're always continuously educating yourself. And we watched this video, and it was the craziest thing. This people say that they wanted to just increase their share price by like 1 or 2 cents, so they did, a little financial misstatements in order to get there. What turned out to be something small, to keep catching up, it turned into millions upon millions of financial statement misstatements to keep the scheme going. So it's amazing. It was just crazy to see, like, trying to just change things by a few cents and see how far that could go. There's white collar crime, defalcation, embezzlement, and irregularities. Auditors encounter two types of fraud. There's employee fraud, and then there's management fraud. So we know the employees are basically the ones that do the employee fraud, and management, upper level people, perpetrator levels of management above internal control structures. So that it frequently involves exaggerated financial statements, kind of the situation I described before, misappropriation of assets, often shrouded in complex transactions involving related third party. So this is something called the fraud triangle. So these are the factors that contribute to fraud. That's one of the things we had to study back when I was an auditor. There's situational pressures. Like in the instance that I was stating before, the pressure was, hey, we need to hit a certain stock price. So we're doing all this fraud to hit a stock price. Next thing you know, that fraud escalates. There has to be opportunity to do it, because if you're locked out, there's no opportunity. You can't commit the fraud. And then ethics, what kind of ethics do you have? So that's your character, your moral compass. So I've actually seen this study stated in one of those things called the CPE, Continued Professional Education Credits. And it does say that, I was shocked when I saw the statistics, that fraud takes up to 5% of revenues. That just seems so high to me, but that's what studies have shown. Most frauds are actually committed by employees other than managers, but the losses are much higher for managers and owners. So that means that while employees do a lot more of the theft, managers, larger dollar amounts, more impact when they do it. Collusion in the commission of a fraud is difficult to prevent and detect. So a lot of times we have segregation of, as I said, collusion, it's difficult. So a lot of time we put internal controls, IT, passwords, if someone has to approve. If you're inputting data into a system, someone else has to approve. So that's how we try to get rid of, preventing people from doing fraud. However, when people collude, all those checks and balances that we put in place, it all goes away because of this. So here's the fraud pressure again. We talked about that. So it's telling you the distribution of losses. So for 55.5% of frauds is between $1 and $200,000. And look at that, 20.6% is $1 million and above. And then it says losses from fraud by the position. So you can see the executive, 18.5% of the frauds, but you see the loss, $723,000. This is another one. It says losses from collusion. So when it's 2 or more, it's higher than when it's from just one person. Losses from fraud by gender. As you can see, men are more likely to commit fraud, 55% to 45%. And on top of it, the losses are greater. You could show, this is a really interesting chart because it says the losses from fraud by age. Apparently, you're more likely to commit fraud from age 51 to 55. And also, it's amazing postgraduate.